Hello, everyone. I'm Mitchell Askew, the head analyst at Blockware. We are a vertically integrated Bitcoin mining company. I lead all of our market research and social media and all of our content. And so, put together this report, and I wanted to run through it in video format and kind of dissect everything we put together here. So, the title of the report is Analyzing the Relationship of Bitcoin Price and Hash Rate, how the dynamic relationship between price and hash rate evolves through the market cycle, creating opportunities for Bitcoin miners. So we're here we're going to be looking at obviously Bitcoin price and hash rate and kind of how they intertwine with each other, what the historical Bitcoin cycles have looked like in terms of hash rate growth and price growth, and then where Bitcoin miners can sort of find their niche in this whole dynamic relationship. So, table of contents, just some of the stuff we're going to go through. We're going to look at the Asic industry from the beginning to now and sort of trends that have developed. We're going to look at historical patterns we've seen in hash rate and what kind of influences growth in hash rate. We'll look at the various stages of the Bitcoin cycle. We're going to discuss how this impacts Bitcoin mining profitability, and then we're going to look at a case study at the end. So, introduction. Timing is arguably the most important factor when it comes to success with Bitcoin mining. You can do everything else right, purchase efficient ASICs, source low cost power, maintain high uptime. But if you enter the market at the wrong time, you'll have less success than you otherwise would. This is different from spot Bitcoin, where time in the market is far more important than timing the market. Even if you buy a market top, you can simply hold your Bitcoin until the next cycle, a strategy famously dubbed as hodling. This report examines the quantitative and qualitative relationship between the price of Bitcoin and the network hash rate to determine when is the most opportune time to start mining Bitcoin. Price and hash rate are the two most dominant inputs when it comes to Bitcoin mining profitability. Mapping out the relationship between the two, what variables impact each, and related trends across Bitcoin cycles will provide key insights into the nature of Bitcoin mining. And again, here are some of our objectives. So we're going to look at the cyclicality in price and hash rate. We're going to determine what variables are primarily impacting hash rate and the trends that have developed. And then we're going to examine the delta, so the growth rate of price and hash rate, to determine the most optimal entry points for a Bitcoin miner or a prospective Bitcoin miner. And then we're going to provide some actionable insights for miners. First, let's look at the ASIC industry, right? And so obviously, before we can talk about hash rate, we kind of need to understand the devices that produce hash, right? And the trends that have developed. So the first ASIC was released in 2013. And for those that don't know, ASIC stands for Application Specific Integrated Circuit. An ASIC is simply a computer that mines Bitcoin. It does nothing else, but it does it very efficiently. They consume a lot of energy and they produce a lot of hashes, which hashes are what allows blocks to be added to the blockchain, et cetera, et cetera. So in November 13, we saw in this table here, I'm looking at sort of the various Bitmain ASICs. So Bitmain is basically the Coca-Cola, the Apple, Amazon of the Bitcoin mining industry, right? They have the most market share. They are sort of the Goliath in the room. And you can see the S1, right? It had 0.18 terahash per second, and it consumed 2,000 watts per terahash versus where we're at now with the S21 XP, which was recently announced, 270 terahash, and it consumes 13.5 watts per terahash, right? So obviously the machines coming out now are way better, way more efficient, way more powerful than the machines coming out 11 years ago. But the primary trend I'm highlighting here with this table is this growth in efficiency, right? So when you went from the S1 to the S3, it was a 60% growth in efficiency. So you went from the S1 consumed 2,000 watts per terahash to the S3 consuming 807 watts per terahash. That's a big jump, right? But as as time has gone on, and ASIC manufacturers have sort of neared the limit of what's thermodynamically possible, we've seen the watts per terahash. Yes, it is still increasing from model to model, but it's increasing at a much lower rate than early on in the beginning days of ASICs, right? You see this jump from the S7 to the S9, 64% growth in efficiency. The S9 to the S17, a 54% growth in efficiency. The S17 to the S19 was a 24% growth versus now the S21 to the S21 Pro, 14% gain in efficiency. S21 Pro to the S21 XP was a 10% gain in efficiency, right? So these machines are getting better, but only at the margins, right? And we've got another chart here that shows this same sort of trend. So the chart on the right here is mapping out the energy efficiency in orange and then the percent growth in efficiency in green, right? And you can see this green line is spike with the S19 XP, but the long-term trend it's down, right? So yes, machines are getting more efficient, but at a less powerful rate at the margin. And then you can see the same sort of similar trend in hash rate, so the actual power of the machine. So if you think of hash rate as sort of you could think of that as like miles per hour if we're thinking about cars, and then energy efficiency would be miles per gallon. So based on energy as the input, how much hash rate can you get? Or based on gasoline as the input, how many miles can you drive with your car with a gallon of gas? And so hash rate here on the left in orange, yes, it's going up, but you're not seeing a massive increase in hash rate from machine to machine, right? Let's go back to this chart. The S21 Pro, 234 terahash versus the S21, 200 terahash. So yeah, it's more powerful, producing more hashes, but not by that much, right? That's what a little over a 10% gain, 15, somewhere between 15 and 20% growth in hash rate. So again, just to reiterate, machines are getting more powerful, more efficient, but at a diminishing degree from each new machine on. And here at Blockware, we kind of describe this phenomenon as ASIC commoditization, right? So meaning newer gen ASICs, they're commoditized in the sense that they are more or less the same, right? I mean, each physical machine, one may be marginally more powerful, right? You can have two S21s and maybe one's hashing at 201 terahash and one's hashing at 199 terahash. But effectively, they're all the same, and that's ultimately a point we may end up at. Again, machines are still getting better at the margin, but ultimately, where we're progressing towards is commoditization among machines. So that's kind of why we refer to this trend as ASIC commoditization. It has three major effects on the Bitcoin mining industry. So first, is you see a prolonged usable lifespan and resale value for ASICs. So if you think early days of Bitcoin mining, a new machine comes out that is 10 times more efficient than the predecessor. Well, the predecessor becomes obsolete overnight, right? It's because, again, these machines do nothing but mine Bitcoin. There's no alternative use case. So it's basically worth paperweight. It's nothing, right? And so there was no resale value and there was really short lifespans on the older ASICs. But we're seeing that trend change now, right? So even an S19, which has been out for over 4 years now, it still has a resale value, right? You can get, you could sell one of those machines for somewhere between $500 and $1,000. Don't quote me off the top of my head. Obviously, it depends on your buyer and their electricity rate and sort of demand based on the Bitcoin price. But ultimately, these machines have longer lifespans, right? This ASIC that was created 4 years ago is still can be effective today depending on your power rate. So there is demand for that, and there's a resale value, and we're seeing that lifespan really grow from machine to machine. So I imagine the machines coming out today, the S21, the S21 Pro, S21 XP, they'll definitely be around 4 years from now and maybe even longer, right? They're probably going to have a longer lifespan, higher resale value than the S19s, where they're at today, 4 years after their release. And the second thing we're seeing is so hash rate delta, the growth in the total network hash rate or mining difficulty. You can think of it that way. It's declining, right? So we're seeing hash rate grow, but it's not growing at the same rate that it was early on in the days of Bitcoin mining as a sort of formal industry. And then the last effect we're seeing is energy and physical infrastructure are now the primary bottleneck for hash rate growth. And what does that mean? Because Bitmain, they can't just create a new machine that's 100x better than the previous machine. How can you push the needle on mining difficulty or the total network hash rate, right? It's physical energy, right? It's physical infrastructure is what's stopping you there. So let's go back to this chart, right? If you have an S21, 200 terahash, 17 and a half watts per terahash, and you're a Bitcoin miner, and all of a sudden the S21 Pros come out, all right? So you can create another mining site and produce more energy and plug S21 Pros in there, but that's going to take a long time. You can also unplug the S21s and plug in S21 Pros. And yes, that's going to grow the total network hash rate, but not as much as flashback 2 cycles ago where you unplug an S9 and put in an S17 in the same spot, that's going to be a major boost to hash rate, right? And so this is kind of a primitive example. You're not really going to see a miner unplugging S21s to put in S21 Pros because the gain there is so marginal, right? It's not really worth the effort of the capital. And so understanding this framework, right? It's like physical infrastructure is what's delaying hash rate from being able to grow by orders of magnitude. It's a real world tangible problem or challenge, I should say. And so to get more hash rate online, you have to produce more energy. You have to build more sites. These are things that cannot happen overnight. And again, we can look at just a simple logarithmic scale chart of the Bitcoin hash rate. And you can see it's going up orders of magnitude every year in the early days, right? And let's see if I can zoom in here. If you look at right here in 2013, so when ASICs were first launched, you see a big jump again. This scale, this y-axis, this is logarithmic. So each jump is a 10x. And you see here, bang, 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 like right in 2013, hash rate grew exponentially multiple times, right? Versus now you're seeing this line sort of flatten out. And so it's telling you that hash rate, yes, it's still growing, but it's not growing like it used to. And you can see it again. Here I've dissected the hash rate growth by epoch. So in the blue line, that was the 25 Bitcoin epoch. So from 2012 to 2016. The orange line, 2016 to 2020. And then the green line here was the latest cycle from 2020 to 2024. And there's a little breakage there from the China mining ban. But yeah, that 25 Bitcoin epoch hash rate grew by 5.8 million% versus the latest epoch hash rate grew by 437%. So huge difference there. People often discuss diminishing returns when they're talking about the Bitcoin price. But when you look at hash rate, which is the second most important variable for Bitcoin miners in terms of their profitability, there's been far more significant diminishing returns in hash rate. And then we can compare it here to price, like I said. So in 2012 to 2016, price grew by 5,400%. And then in 2020 through 2024, it grew by 660%. So you actually saw in the latest cycle, the price grew by a greater percentage basis than hash rate. And yes, there's diminishing returns in both, but it's far more drastic in hash rate, right? 2016 cycle, hash rate went up 7,000% versus 400% in the latest cycle. Versus price went up about 1,500% in 2016 versus 600% now. So that difference there is much more pronounced when you're looking at hash rate. And now let's kind of talk about Bitcoin cycles. And so first off, whether or not you think the halving is a bullish price catalyst is maybe it is, maybe it isn't. I tend to believe it is. But historically, we've seen Bitcoin move in a cyclical manner surrounding these halvings. So the first sort of stage we're looking at is the actual halving itself. And what effect does each of these stages of the market have on the total network hash rate, right? Another way to think of that is how are miners responding to halvings and changes in the price? Because miners are just entrepreneurs. They're profit-seeking individuals, businesses, and so they respond to changes in the landscape of Bitcoin mining, right? So if the price goes up, you're going to see miners respond by deploying more hash or building more sites. Versus when the halving happens and mining block rewards get cut in half, you're going to see miners respond accordingly, right? Maybe they need to upgrade hardware. Maybe they become unprofitable and stop mining altogether. So as responsive individuals, how are miners responding to the various sort of the cyclical nature of Bitcoin price and also Bitcoin halvings? The first stage is the actual halving, right? So what we're experiencing this right now, right? We had a halving in April, and hash rate has grown, but hardly at all, right? We saw a huge miner capitulation this summer, and overall hash rate's not really up, but a couple percent from where we were at in April after the halving. And so you tend to see hash rate stagnate after the halving, right? You see struggling miners trying to stay afloat, depleting their treasury, doing what they can. And then ultimately, you do see a large capitulation or moderate-sized capitulation. You see the unprofitable miners, they unplug their machines, and you see some negative difficulty adjustments, which is exactly what we saw this summer. So you don't really see any crazy growth in hash rate for the first, 6 months after a Bitcoin halving. The next stage is the bull market, right? And once all the struggling, unprofitable miners have fully capitulated, they're done selling their Bitcoin treasury, trying to battle and stay profitable and stay in business. You see the Bitcoin price tends to respond to that decrease in sell pressure, and it responds violently, right? Bitcoin during bull markets, it's not linear, gradual move up. It's explosive, it's exponential. In 2020, Bitcoin was at 3,000 in March after the COVID crash, and then a year later, same time in 2021, it's at 60,000, right? So it's a 20x within 12 months. These moves during the bull market, they're pretty extensive. They're pretty rapid and violent in price, that is. And you also see hash rate and network difficulty start to rise during the bull market as well, but it's not increasing 20x like the Bitcoin price is, right? Because think back to what we were talking about earlier, physical infrastructure and ASIC production and literally generating energy, producing energy, that's the bottleneck for growing the total network hash rate versus price. It functions on a bid ask system. So if there's no more sellers at a certain price, and there's no more sellers at a price 10% above that, you can see how the Bitcoin, when there's bidders, they can just send the price up very quickly. There's nothing physically that can stop price from increasing by 2x if that's just what the supply and demand dictates. The next stage of the cycle is, of course, the bear market. And Blockware, we've gone by this sort of thesis, this idea of energy gravity, right? So in the bull market, price is ripping, difficulty's not ripping nearly as fast, mining profitability skyrockets, right? It makes a lot of sense to start mining Bitcoin at some point versus buying Bitcoin. And what you see, that dynamic causes capital rotation. So you see more miners maybe selling the Bitcoin they have to invest more into mining, or new market participants, rather than buying spot Bitcoin, they go and buy Asics, or they start to build out a mining site, right? You see capital, instead of allocating it to spot Bitcoin, it starts to allocate into mining. Because if Bitcoin is $500,000 a coin, but you can mine a Bitcoin for 70,000 in electricity, it makes a lot more sense to start mining. And so you see capital flow into mining. And a block where we've sort of called this energy gravity, which I'll show you the chart later in this presentation. But that's sort of the main feature of bear markets, obviously, is the Bitcoin price goes down, but you see hash rate continue to go up. We saw this to a very strong degree in 2022. So all of the investment that is made in the bull market into mining, right, this capital rotation, not only that's buy pressure coming away from spot, but because it's going into mining, you see that manifest into higher hash rate, higher network difficulty during the bear market, because again, that investment into mining doesn't immediately, it's not an ASIC plugged in right away, right? It takes time. And so you see sort of 6 to 12 months later, that really materializes into hash rate online. So the bear market, you have price going down, but hash rate still going up. It's kind of two conflicting forces, both working against Bitcoin miners in that scenario. And then sort of the last stage we see is what I call the recovery phase of the Bitcoin cycle. And so here you see what we saw in the last cycle. So think, post bear market bottom, 2022 FTX collapse until the end of the cycle. You saw a very kind of tight correlation between Bitcoin price and hash rate. And if you think about it logically, let's say you're a miner and your break-even cost was $20,000 per Bitcoin. So Bitcoin goes below 20,000 in November 2022, but it's back up above 20,000 by January, right? And so you unplugged in November, but you plugged back in January, right? And so there's this sort of linear correlation almost between price and hash rate during that phase of the cycle. Plus, typically, ASIC manufacturers also operate around the Bitcoin halving, so they kind of are, the development of new generation ASICs is also on mostly a 4-year cycle, and you see marginal upgrades throughout a cycle, but generally you're not going to get crazy new hardware to come out mid-cycle that can push hash rate up. So this sort of recovery phase, you see Bitcoin price rising, hash rate rising. Also, another sort of catalyst there for rising hash rate at the tail end of an epoch is miners preparing for the next halving, right? So they want to make sure they have the most efficient machines possible before the block subsidy gets cut in half. And here I've mapped out the latest two Bitcoin cycles, and you can see these phases of the cycle at play. So here in 2016, hash rate, nothing too crazy for the first 6 months after the halving. And then 6 to 18 months after the halving, you obviously see price just take off. It went from a few $100 down here up to 20,000 at the peak of the 2017 cycle. And then you see here during the bear market, hash rate here is growing more than it was during the bull market, but price is also going down. And then obviously there was some volatility, but generally speaking, in the last phase of the epoch, price and hash rate are both recovering. And then here in 2020, you see mostly a similar trend, right? You've got stagnant hash rate for the first 6 months, relatively stagnant price, nothing too crazy. And then 6 to 18 months after the halving, so around 1 year, that time frame, that window, you see price just absolutely rip, and you see hash rate generally going up. Obviously, here you see it go down, and that's because of the China mining ban, which also affected price, right? Because these miners had to move. It's sort of an anomaly, right? It's not obviously this event isn't going to happen again, not to this extent, but these miners had to sell their Bitcoin to move their fund the moving of their operations over to the United States or just outside of China. So you saw hash rate and price both go down, kind of canceling each other out in terms of uh, where Bitcoin miners are at and where their head is at in terms of profitability. And then in the bear market, right? So think at the end of the bull market, Bitcoin is almost $70,000. Why would I buy Bitcoin when I can mine Bitcoin? Capital stops going into spot Bitcoin, starts going into Asics, and you see price go down and hash rate go up. And then again, like I mentioned in the last phase of the cycle, we're seeing a pretty tight correlation. Hash rate really grew the most in the last 12 to 18 months of the past Bitcoin cycle. And we'll dissect that a little bit further, but we're seeing a pretty tight correlation there between price and hash rate. And here, excuse me, we're looking at the actual raw numbers. So based on each phase of the Bitcoin cycle, and there's three kind of key points here. I know there's a lot of numbers on here, so I'll explain it. The first is the growth of hash rates declining each cycle, like we've discussed. The second is that the difference between the growth in price and the growth in hash rate, you're seeing the most pronounced during the bull market, which is obvious, right? Because price is growing exponentially. And we can kind of ignore the 2012 to 2016 cycle just because that was when ASIC's first launched, right? So they hadn't commoditized yet, right? Each new machine was orders of magnitudes better. So you saw hash rate grow almost 80,000% during that bull phase. But as things sort of normalize, the ASIC industry is more modernized to where it's at today in 2016 and 2020. Look at these bull cycles, right? You see price grew 1,460%, while hash rate only grew 500%. So if you're a Bitcoin miner during that time, your profit margins are rapidly expanding. Same thing in the 2020 cycle during that bull era. So think 6 months after the 2020 halving to 18 months after the 2020 halving, which is this window right here. Price grew 300%, while hash rate only grew 26%. Great time to be a Bitcoin miner then. But inversely, during the bear market, price dropped 70% and hash rate continued to grow. And then the last key point here is if you look at the latest cycle, right? When did the majority of hash rate growth happen? It took place during the last phase of the Bitcoin cycle. Each subsequent phase, hash rate actually grew more. So again, it's this idea of mining gets really profitable in the bull market. Everyone wants to start mining then, but you don't actually see hash rate grow until 12, 18, 24 months down the line because of physical energy being this primary bottleneck. Hash rate cannot grow overnight in the same way that price can. And then the last sort of point on this is you can see, right, this whole idea is like miners are responding to changes in the Bitcoin price and they're responding to halvings. And you can see this nature, this sort of desire of miners to respond. You can see them being rational actors when you look at hash ribbons. So a hash ribbon shows you miner capitulations. When is hash rate going down now relative to where it was? So if the 30-day moving average is below the 60-day moving average, you know that in the aggregate, miners are unplugging. And you can see when does this typically happen? Well, here in 2020, after the COVID crash, price went down. You have a hash ribbon. Miners capitulated because Bitcoin price is lower. Some miners are unprofitable. They have to unplug their machines. You also see another hash ribbon here after the halving. So block subsidies cut in half. You see a miner capitulation as denoted by hash ribbons. You see another one in 2021 when the China mining ban happened, right? Different, but again, they're responding to changes in the outside environment. Miners are rational entities, profit-seeking individuals. And then you see another one here in 2022. You see two here when the Bitcoin price is going down, inefficient miners with either outdated hardware or high electricity costs or both, they have to unplug their machines. You see a net decrease in hash rate. And so you see another one here this summer. We had a miner capitulation after the halving. And so again, the point here to illustrate is that miners are responsive. They react to changes in their environment. And then let's just read this paragraph here. The majority of hash rate growth taking place within phases 3 and 4 of the latest Bitcoin cycle is indicative of the effect that Asic commoditization is having on the industry. Miners are responsive to increases in the Bitcoin price, but it is taking a longer amount of time to see this manifest into a corresponding rise in hash rate. This hash rate stickiness occurs because a substantial rise in hash rate can only be achieved through the development of physical infrastructure in real-world energy, components which require time and labor. The Bitcoin price can increase by many multiples in short order, while hash rate growth of equal magnitude takes much longer. Therein lies the opportunity. And so let's talk about how this affects the profitability of Bitcoin miners. And again, this isn't direct financial advice by any means. We're just looking at metrics that show how much money are Bitcoin miners making objectively. And the first thing we're looking at here is hash rate. And then we also have charted the year-over-year percent growth in hash rate. And so you can see hash rate down, the long-term trend, obviously, because mining difficulty is going up. So, we have a few other metrics we're going to look at because hash rate has some flaws, again, because, a hash is not equal, right? If you had 100 terahash in 2013, you're in a much better position than if you have 100 terahash now, right? I don't think anybody had 100 terahash back then. And so it's not necessarily fungible, right? One unit of hash today is not equal to 1 unit of hash 4 years ago, 8 years ago, 12 years ago. But generally speaking, hash price, which is what we're looking at here, which is miner revenue per terahash per day, it shows you kind of how much money miners are making and you can sort of quantify that. And so these green bubbles here, right? These green filled in area charts. This is when hash rate or hash price, I should say, is positive on a year-over-year basis. And you see, it doesn't happen often, but when it does, it's huge, massive gains. Hash price growing over 300% on a year-over-year basis during each of the last Bitcoin bull cycles. So this is, mining profitability gradually going down during the bear market. During the bull market, it absolutely explodes, rips your face off. 3x in a year type of scenario, right? And these are very explosive windows, right? You're not going to see really a gradual increase in mining profitability. You're going to see the Bitcoin price rip, hash rate can't respond immediately, and the profitability of Bitcoin mining just absolutely tears through the ceiling, which who benefits the most in this scenario? It's the Bitcoin miners that are already on the network, the ones that don't need to go and now invest in infrastructure and ASICs and energy production, the ones who are already they've done that, right? They're already online. They're capturing all of this window of profit growth. And then here, energy gravity, like I mentioned, hash price has some issues comparing over time, but this is a more neutralized version of that. So you're looking at instead of dollars per terahash, you're looking at dollars per energy per kilowatt hour. So you can see here again we had massive explosive growth in energy gravity during the bull cycles previously, even more so than when you're looking at hash price. So we mentioned energy gravity too earlier, right? You can see this sort of separation between this black line and this green line. So the green line is taking the average industry standard ASIC and industry standard electricity rate for the time and determining what is the cost to mine one Bitcoin for the average miner. And then the black line here is the Bitcoin price. And so obviously when there's a huge separation between this green line and this black line, it's like, hey, Bitcoin is 60,000, but I can mine a Bitcoin for 10,000 electricity. It's a great deal for Bitcoin miners, right? And you're going to see that capital rotation. So anytime there's a huge separation between these lines, it might, Bitcoin price might be a little overheated, right? You might start to see that capital rotation. And then anytime these are really close together, like bear market bottom, halving, bear market bottom, halving. Basically, it costs just as much to mine a Bitcoin as it does to buy a Bitcoin. So you good chance though that Bitcoin is pretty undervalued in that scenario. And then one more chart here illustrating the similar dynamic of explosive windows of profitability. Let me zoom in on this one. Is here you see these green, the green is the month over month growth in price, and the orange is the month over month growth in hash rate. So really only a few months where this green line is above the orange line, but it's a pretty big difference there. And so you want to make sure you're really capturing these moments where price is growing at a faster rate than hash rate. Because as a miner, that's when you're going to be the most profitable. And then let's look at a case study to sort of wrap this up. Let's take these trends and apply them to the present Bitcoin cycle to get a reasonable estimation of future profits for Bitcoin miners using the latest generation Asics. The purpose of this case study is not to speculate on Bitcoin price action, rather, it's to see how Bitcoin mining will perform in different scenarios. Below are the assumptions we'll use for the case study. So, again, total hash rate growth in this cycle, so 2024 through 2028, it's going to be less than it was in the previous cycle. And we're going to see most of that hash rate growth occur later in the cycle because of ASIC commoditization and physical energy as the bottleneck. And then for this case study, we're going to assume an Antminer S21, so 200 terahash, 17.5 watts per T, and then electricity rate of 7.8 cent per kilowatt hour, 95% uptime. And then we're going to do a bear case and a bull case. So first with the bear case, let's say Bitcoin price goes to 150,000 this cycle, which many analysts or Bitcoin think boys have predicted much higher. Even your guys like TradFi, Fidelity, BlackRock, I don't think they're expecting 150K Bitcoin this cycle. I think most everyone is expecting much higher. So it's a pretty conservative estimate, right? And we're also going to assume a 200% total growth in hash rate over that cycle. So last cycle, we saw about 440%. Assuming this trend of diminishing returns in hash rate continues, which is reasonable to assume based on the things we've discussed here, then 200% total growth in hash rate from where we're at today, which is around 600 exahash. So we would end up around, let's say 1800 exahash by the end of the cycle. I think that's very reasonable. And then we're going to assume 50% of that occurs during the last phase of the Bitcoin cycle. So phase 4, sort of the recovery phase. You have your halving phase, you have your bull, your bear, and then the recovery at the end. We're going to assume a lot of that hash rate growth occurs there in the recovery. And so what happens in this scenario? So hash price reaches 9.6 cents at its peak, and one single S21 profits about $6,500 over the course of the epoch. And so again, this is a very bearish scenario, and you're still seeing an S21, which they sell for much less than 6,500, around 4,000 to 4,500. You're going to see a profit. So Bitcoin that it's producing with that its revenue that it's mining, the Bitcoin it's mining, minus the electricity cost for running the machine, that gap there, that's its profit. So the orange here is the revenue, or sorry, the orange is your cost, right? You can see it's fixed over the cycle because it's going to consume the same amount of energy at a locked-in rate versus the dollarized value of the Bitcoin that you're mining is going to fluctuate. So during the bull market, the dollarized value of that Bitcoin is much higher, meaning you'll have to sell less of that Bitcoin to cover your electricity. And so the net profit there, operational profit, the Bitcoin you actually get to hold and keep as a miner, you're going to be able to hold a lot more during the bull market. And so the dollarized value of that Bitcoin, your profits in this scenario for an S21 would be about 6,500 for a single S21 over the next 4 years. And then let's look at a bull case. So you can see here, obviously, in this bull case, we are assuming a $400,000 top for Bitcoin this cycle, which I think is it could happen, right? That would obviously be very bullish, very good from where we're at 60K now, right? Over almost a 10x. But yeah, so that's sort of our bull case, and then we're also going to assume hash rate grows more in that scenario, right? So if Bitcoin price goes to 150K versus 400K, you're going to see more investment into mining in the 400K scenario because the profitability is so much greater during the bull peak that ultimately hash rate's going to grow more, right? When price grows that much. And so we're also going to assume 50% of that hash rate growth happens during the last phase of the cycle. And so you can see here this window of profitability is just totally explosive, rips the face off for miners. So in the 6 to 18 months after the halving, which is when we would expect this bull market to really take hold, which would be next year, 2025. You can see here mining profitability, like on a monthly basis, you could see an S21 possibly bringing in $1,400 worth of Bitcoin, and the electricity rate is fixed at $200. So you're going to be miners with an S21 in that scenario, you're going to be able to hold pretty much all of the Bitcoin that they're mining. They won't have to sell much at all to cover their electricity rate. And also in this scenario, we see hash price peak at around 24 cents per terahash per day. And if we go back to this chart of hash price, let's actually, yeah, this may actually be the only chart of hash price. So it peaked at around sort of 40 to 50 cents last cycle. So even in our bull scenario, hash price is only reaching half of what it was during the last bull peak. So I feel like that's pretty reasonable, pretty conservative. I don't expect hash price to get back to where it was last cycle. I mean, obviously, if Bitcoin goes to $1 million a cycle, then it probably will. But this bull scenario is still reasonably conservative in terms of hash price. And so in this bull scenario, we would see a single S21 profit 15 grand throughout the cycle, rather than the bull scenario or the bear case, it would be about 6,500. And then let's compare this lastly to spot Bitcoin. So this here is also our bull scenario, but I also opted to include additional 5% in revenue from on-chain transaction fees. So that's sort of the dark horse we haven't discussed here if we're thinking about how miners are going to be profitable during the coming cycle is fees. We saw fees be during the sort of 2023 ordinal craze. Fees were a huge chunk of the block subsidy, and so miners can expect reasonably that they're going to get a huge boost in revenue that they didn't really expect, and it's going to be volatile during the coming bull cycle, right? Because a lot of people are going to be trying to transact on chain, but only so many transactions can be included in each block. So users are going to have to bid, which that fee revenue ultimately ends up in the wallets of Bitcoin miners. So we have a conservative estimate of additional 5%, but just know that during a bull market, this could really be much higher. We could see fees easily being 50% of total miner revenue. So pretty a low end estimate here for fees, but I opted to include it here. And then same breakdown. You got an S21 at 7.8 cent per kilowatt hour, 95% uptime, and then let's assume the machine cost is $4,000 for the machine, and that's this bottom dotted line here, right? So $4,000 at the 60K Bitcoin price we're at roughly now. You could, instead of buying the ASIC, you could just buy spot Bitcoin and you'd get about 6.6 million sats, so 0.066 Bitcoin. That's your hurdle rate here as a miner. Well, let's look at the profitability if you opted to buy the machine instead over the course of the epoch in this scenario. So 400,000 Bitcoin top, hash rate grows 300% throughout the cycle. You get a pretty nasty 70% drawdown like we've seen historically. So it'd be going from 400K to about 120K Bitcoin bottom in the next cycle. The mining still outperforms. So a single S21 is going to accumulate in profit, accounting for the fact that they have to pay for the electricity with the Bitcoin that they're mining. They're going to stack 0.076 Bitcoin. So about a 15% outperformance of just buying spot Bitcoin if you buy an S21 and you mine at 7.8 cent per kilowatt hour. So obviously, Bitcoin is the benchmark for a lot of people, and it's tough to outperform. Buying and holding spot Bitcoin is a pretty safe play a lot of the time if you can stay solvent and you can hodl it. And so if that's your benchmark, trying to outperform Bitcoin, how are you going to do it? Are you going to speculate on altcoins? Are you going to leverage trade, or are you going to mine? Because mining seems to be a lot better of a way to do that. And then lastly here, in this sort of case study here, the thing we don't account for is the resale value of the machine, which, as we alluded to earlier, you're seeing a longer resale value for each new generation ASIC. So here you could easily see S21s not only maintaining value by the end of the cycle, but you could see their price go up pretty extensively during the bull market. And so this is what we saw with S19s in the last cycle. So their price on a dollar per terahash basis at the start of the cycle around $25 per terahash, and then in the peak in 2021 in the spring, it was over $120 per terahash, and then over $100 per terahash in the fall in November 2021. So obviously the price of your machine that is capable of mining Bitcoin at a discount is going to go up when the price of Bitcoin's ripping and everybody wants to mine instead of buying spot Bitcoin. You're going to see increased demand for ASICs. ASIC prices are going to rise accordingly. And so it's something miners are now able to capitalize on by being able to resell their machines through the Blockware marketplace. And let's read our summary here. Here we examined the dynamic relationship between Bitcoin's price and network hash rate. Unlike holding Bitcoin where time in the market is more important than timing the market, entering the mining market at the right moment is crucial for success. Historically, the Bitcoin network has experienced diminishing returns in both price and hash rate growth with each cycle. However, the decline in hash rate growth is notably steeper, presenting unique opportunities for miners. Moreover, as Bitcoin's price surges, hash rate lags behind due to the time-intensive nature of developing physical infrastructure and energy resources necessary for mining. This lag creates windows where mining revenue can skyrocket, particularly in the 12 to 18 months following a halving event. To stay ahead in this competitive industry, it's vital for miners to align capital deployment around the 4-year halving cycles. Understanding these dynamics and acting accordingly positions miners to experience maximum benefit during Bitcoin bull markets and minimize downside risk during bear markets. And what's the actionable insight for you? If you're listening to this, all right, this all sounds great, but what can I do about it? Well, you can deploy capital into Bitcoin mining at the right time, right? You want to buy ASICs when they're not $100 per terahash. You want to buy them when they're $20 to $30 per terahash instead. And so buying objectively by what we've looked at here, these trends in price and hash rate now is one of the best times, if not the best single time in the cycle to deploy into Bitcoin mining, right? You just had S21s come out and you're seeing, S21 Pro, S21 XP. Yes, they're better, not marginally better, right? You can head into the newest generation of machines and you're not going to see a new crazy new model come out until probably 2028. That's really, really a lot better. So you can get into the newest hardware and you can get in before we have this institutionally driven Bitcoin bull market. Global liquidity is rising. A lot of people are very bullish on Bitcoin, which we've put out extensive research on why you should be bullish on Bitcoin itself, which I imagine a lot of people watching to the end of this video are bullish on spot Bitcoin. So how can you really position yourself to be long Bitcoin during the coming year? Mining is going to be the best way to do so. And if you're interested in getting started with mining Bitcoin, definitely check out Blockware. We have the Blockware marketplace, which allows you to buy and sell ASICs turnkey. We also have great deals for OTC buyers. So if you want to buy machines in bulk, definitely contact our sales team, sales@blockwaresolutions.com. If you just want to buy 1, 2, or 3 machines, head to the marketplace, marketplace.blockwaresolutions.com. We've got machines that are already plugged in, right? So a huge problem that our marketplace solves is this lag, right? If you want to start mining, you can buy machines that are online right now. And you as an individual, you don't have to wait for your site to get built out, for the machines to get sent over from China and finally plugged in, where there could be months between when you buy a machine and when you actually are mining. And, these windows are explosive and they're short and you don't want to miss them. You want to make sure you're online as a miner for the entire duration of the bull market. So our marketplace really solves that issue for a lot of miners. And the last thing is we are running a huge Labor Day promotion. So if you're watching this video when it comes out before the end of this week, so Friday, September 6th, all of the rigs at the Iowa site on the marketplace and the Texas site have discounted hosting rates. So typically our Iowa site, you can get a rate of 7.8, which is what we used for this case study here. But if you buy before the end of the week, you can lock in a rate of 7 cents per kilowatt hour. So the way this works is when you buy an ASIC through a marketplace, you're also hosting at one of our various data centers with low electricity rates. And you sign a hosting contract for anywhere from 1 to 3 years. And your electricity rate for the duration of that contract is fixed. And so you can lock in a fixed rate of 7 cents for the next 3 years. But because of our marketplace, because you can buy and sell your machines, you're not actually like locked into this contract. If you want to get out, you want to stop mining Bitcoin for whatever reason, maybe we're in the bull market, you want to sell your machines because machine prices went up, you can do that. You can sell your machine and you're out of your contract when the machine sells. And then also we're running a huge deal on S21 Pros. So if you want to buy some bulk S21 Pros, 5 machines or more, definitely contact our sales team and you do that before the end of this week and you'll get a great deal. So Appreciate you all you guys for watching. Make sure to leave a comment below if you have any questions, want to talk about what we went through here, and appreciate you all for watching. Make sure to like, subscribe, follow, retweet, share, etc.